Good morning, everyone. This is Professor Neerav Gouda from Department of Accountancy. Today, I'll be taking up the topic from TYBCOM Semester 6 Financial Accounting. So, today's topic, which we are going to cover, is amalgamation of companies as per AS 14, that is Accounting Standard 14. So, today we are going to learn about what is amalgamation, what is absorption, external reconstruction as per AS 14. We are going to also learn what is the accounting procedure which a company has to follow on amalgamation. We are going to also see about what is purchase consideration and how this purchase consideration is calculated. So, the weightage of this particular chapter is 100% optional with 15 marks each question will be there on this particular chapter. So, actually, what is amalgamation? Amalgamation is nothing but a combination of two or more firms. We have already studied in SYBCOM amalgamation of partnership firm. Amalgamation of partnership firm was wherein we had learned about how the partnership firm, two partnership firm comes together and carry on their business over a period of time. Here we are going to learn about amalgamation of companies wherein two companies come together and join their hands for many of the advantages which they are going to get after amalgamation. Now the advantages can be in the form of increased production. It can be in the form of increase in efficiency of both the companies. It can be in the form of increase in volume or turnover or profit of both the company. And this all together will lead to reduction in competition which they were facing prior to before to amalgamation. So amalgamation is nothing but wherein two or more existing companies goes into liquidation. That means they close down their business and the new company is formed to take over their business. In our example, if you can see, company Y was an old company. Company Z is also an old company. They will sell off, they will transfer all the assets and liabilities to a new company, which is company Y and Z, and they will carry on their business. So that is nothing but amalgamation. Next, we will see what is absorption. Under absorption, one or more existing company goes into liquidation and some existing company takes over the business. So in our example, there is company A as well as there is company B. Company A has an efficiency with respect to the capital part and company B has an efficiency with respect to production strategies. So now these two companies come together and formulate a new company which will be called as company A. So it is nothing but absorption. Now let us take a real case study wherein Vodafone has taken over Hutch Limited and then they are carrying on their business under the one name which is nothing but Vodafone Limited. Coming towards the third part, which is external reconstruction. Now my dear students, we have already done internal reconstruction in semester 5. Internal reconstruction is nothing but we are going to reconstruct the company internally by bringing down the value of an assets which are overvalued by writing off the losses through a capital reduction scheme. But in external reconstruction, there will be a new company which will be formed. The management, the employees, the shareholders of the company will remain same, but the company will get a new name. Yeah, one new existing company will come into consideration and will be running on the business. Yeah, it will be formed and it will be running their business. So here company X was an old company which has transferred all the assets and liabilities again to a company X with some new name. All the purchase consideration will be paid off, and then the new company will be taking over its business of the old company, and then they will run the business. I'll take an example of LG. LG was previously known as Gold Star, which is a Korean company. Gold Star was running its business in Korean continent, but then they wanted to expand this brand. So they transferred this company to a new venture, a new company which was known as LG, which is Life Good. And now this Gold Star is been running under this particular brand name which is known as Life Good. So all the assets and liability of Gold Star became the assets and liability of LG, and it is carrying on the business under the name of LG. So this is nothing but external reconstruction. Basically, external reconstruction is for a sick unit. Yeah, it is for a loss making unit, and a loss making unit tries to convert it into a profit making unit if the prospectus of the company are going to be good. So this is what about external reconstruction. Accounting standard 14 scope. The accounting standard 14 is been recommended by ICAI, that is Institute of Chartered Accountant of India. ICAI is the regulatory body which formulates the accounting standards, and every company operating in Indian geographical boundaries have to follow this accounting standards. So accounting standard 14 states about amalgamation. Amalgamation is nothing but it includes merger also. Now, what is merger? In the next point, we will be taking up that particular part. Transferor company. Transferor company is nothing but it is a vendor company. It is a vendor company. And transferee company is nothing but it is a purchasing company. Suppose A and B are two companies. A takes over B Limited. So A becomes a transferor company and B becomes a transferee company. Now coming towards merger. Merger is a part of amalgamation, and it is nothing but combination of two firms. In merger, merger is nothing but the option wherein two companies not only pulls the assets and liabilities of that particular company, but they take over the share capital as well as reserves and surplus of the previous company. Whereas in purchase method, it is exactly opposite. Only the assets and liabilities are transferred. The shareholders liability is not transferred in the books of new company. Whereas in merger, this particular point is taken into consideration, that with the pooling of assets and liability, even the capital is been pooled by the by the new company, and then the new company will run on the business. So this is all about what is accounting standard 14. Now we are going to see the types of amalgamation. Amalgamation in the nature of merger as well as amalgamation in the nature of purchase. Dear learners, as per the syllabi of our college is concerned, it is amalgamation in the nature of purchase which is going to be there in our syllabus. Amalgamation in the nature of merger is not there in our syllabus. So we are going to majorly focus on amalgamation in nature of purchase in the coming sessions. Now what is amalgamation in nature of merger? It is nothing but transfer of all the assets and liabilities at the book value. Here we are just concerned about the book value. Yeah, just we are concerned about what we say the balance sheet values of the assets and liabilities. Whereas in purchase method, the system is totally different, that we will be covering when we will be starting with amalgamation in nature of purchase. Second, we require 90% of the equity shareholders sanction for converting a firm into a existing firm to a new firm. That is, that a company given its full consideration of converting an existing company into a new company. So 90% of the shareholders are required for the sanctioning under special resolution. Third important part in amalgamation in nature of merger is that the PC has to be satisfied in equity shares only. The purchase consideration cannot be given in the form of preference shares, cannot be given in form of cash. It has to be the satisfaction, yeah, the transfer has to be in the mode of equity shares only. Then the same business will be continued, and the recording of assets and liability has to be taken at book value or balance sheet value. Amalgamation in nature of purchase. If any of this above conditions are not satisfied, that is transfer of assets, 90% of equity shareholders giving their sanctioning, then purchase consideration is in the form of equity share, the same business continuity, then the amalgamation nature of purchase will come into picture. While in merger, the interest of equity shareholders of both the companies merge and join together. In purchase method, the company makes an outright purchase of interest of equity shareholders of another company. Amalgamation nature of purchase. The first point is recording of assets and liabilities. In merger, the recording of assets and liabilities is to take place at book value. But here, the recording of assets and liability will be done at fair value, yeah, at an agreed value. So, a company will find out the real valuation of the assets and liabilities and will take into consideration that particular value. If the value is not available, then the book value or balance sheet value will be the base for it. Second important part, which is not there in merger but it is there in purchase method, is recording of statutory reserves. Dear students, there are many kind of statutory reserves which a company has to keep aside for the future provisions and contingencies. Likewise, export profit reserve. Now, what is the basic ideology of this export profit reserve? Export profit reserve is a reserve which is created for the fluctuations in the exchange rate. If there will be fluctuation in the exchange rate in future, any profit and losses will be set off against this export profit reserve. So let us take an example that A is a company which is going to take over the business of B, and B company is into only export sales. So naturally, whatever money they are going to receive towards outstanding amount, it will be either having a new transaction rate, yeah, it will be as per the future rate which has been decided by the party. But now, since both the company are going to merge, the A company will not bear that particular loss. Why? Because previously it was only having a domestic sales into hand and B was only into an export oriented sales. So the transfer of this particular reserve is necessary so that if in future if there is any fluctuation in the foreign exchange rate, then this profit and loss can be set off against export profit reserve. Likewise, there is a second statutory reserve which is very important, is investment allowance reserve. Let us say the same example. A Limited is a manufacturing company and B Limited is an investment company. Now these two companies are going to merge their business. So the investments of B Limited will be transferred into A Limited books. So whatever profits and losses occurs accrues during the fluctuation in the market price, that profit and loss will be set off against investment allowance reserve. So that is the specific reserve which has been created for investment. Let us take third type of reserve, which is foreign project reserve. Foreign project reserve is nothing but the reserve which is created for the foreign projects, the outside the geographical boundaries of India. Whatever projects a company is going to take, any profits and losses due to the changes in the exchange rate has to be set off against this foreign project reserve. So this three types of reserves are compulsory to be taken over by the new company while the amalgamation takes place, yeah, while absorption takes place, yeah, external reconstruction takes place. Now the question comes that there will be a difference in purchase consideration. Yes, definitely there will be difference in purchase consideration. Why? Because in the previous method, that is in merger method, all the assets and liabilities were taken at book value. But in purchase method, it has been taken over at fair value. Yeah, it is taken at an agreed value. Yeah, it is taken at an market price. So naturally, there will be the difference in purchase consideration, whatever the company is going to receive. So the resulting effect of this difference will be either goodwill, either capital reserve. Now, how goodwill and how capital reserve we will be seeing when we will be doing up the practical part of it, and we will be passing on the journal entries. Next, what is this purchase consideration? Now, from the starting of the lecture, I'm talking about what is purchase consideration, and how it is to be dealt with it. So, purchase consideration, as per Accounting Standard 14, it is nothing but the aggregate value of the shares and other securities issued, and the payment has to be made in the form of cash or the assets by the transferee company to the transferor company. Transferee company and transferor company, we will be taking a very simple name of it, is nothing but a vendor company and a purchasing company. So the payment which is made by the purchasing company to the vendor company is nothing but consideration. Definitely, as an individual investor of a company, you are not going to sell your company free of cost to the other company. So you are definitely going to charge something. So that nothing, that charging, that what the consideration which are going to ask for, it is nothing but your purchase consideration. My dear students, while preparing PC, you have to be very clear about it that all the external liabilities have to be exempted. It should not be taken into consideration while calculating the purchase consideration. Maybe if you are paying to debenture holders, maybe you are going to pay to the creditors, maybe you are going to pay towards outstanding expense, that has not to be taken in calculation for purchase consideration under net payment method. Now there are two types of method of PC. One is net payment method and one is net asset method. If the mode of discharging PC is given, then we will be following net payment method, and if the mode of discharge is not given, then we are going to follow net asset method. Dear friends, what is net payment method? In net payment method, all the payments will be made by the purchasing company to the vendor company in the form of bundles. Now, what is this bundles all about? The bundle of equity share, bundle of preference shares, bundle of cash. So, this all together is nothing but my net payment method. So, this is the format which we are going to use for net payment method. On one side, it will be mode of discharging the PC. Second, number of shares, issue price, and third is the rupees. So to find out the rupees value, yeah, the monetary value, number of shares multiplied by issue price will give us the monetary value of a PC. Sum total of it will be nothing but my total purchase consideration. Now it is not necessary that at each point of time all the data will be given in the question. If suppose say that company A has taken over company B and the purchase consideration was satisfied by 1000 shares of 100 each and balance in cash. So in this case, net payment method we are not supposed to apply. In that case, we will be first calculating the PC as per net asset method. After finding out the net asset of the company, that is total asset minus total liability, we will be distributing that PC as per the sum, and then whatever balance is left out will be paid off in the case in the method of. So net asset method is taken into consideration wherein the total assets are being taken at an agreed value less total liabilities will give me my purchase consideration. So the resulting effect of this if will be goodwill, yeah, capital reserve. So here we complete the theoretical aspect of the chapter. Now let us see how this particular accounting procedure has to be followed. So first, before starting with the question, that is whenever you get a question paper, before starting the problem, first we have to look towards the balance sheet which is given in the question. Now it starts with share capital. Under share capital, it is authorized, issued, subscribed, called up, and paid up. Then we have reserves and surplus. Then we have something called as unsecured loan. We have unsecured loan, current liabilities, and provision on liability side. On the asset side, we are having fixed asset, we are having investments, we are having current assets, loans and advances, and we are having miscellaneous expense. Now, the first step is, yeah, in the problem, we are supposed to find out which item belongs to which particular heading. So for that, the marking is important, because unless and until if you do not know where that particular item will be posted, you will not be able to start up with the sum. So let us see each and every item where the posting is done, and then we will be passing on the journal entries in the books of old company and in the books of new company. Starting with preference share capital. Preference share capital, as a name suggests, it will be transferred to PSH account, and liability always have a credit balance. So whatever balances we are going to transfer on the liability side, it will be transferred to the credit side of your ledger account. Calls in arrears stands for CIA. CIA is nothing but the amount which is not paid by the shareholder. So it will be transferred to preference shareholders account debit side. Next is equity share capital. Equity share capital is nothing but they are the equity shareholders. They are the residual owners of the company. They are the ones who are going to get the profits, and they are the ones who are going to bear the loss for the company. So equity share capital will be transferred to ESH account credit side. ESH account stands for equity shareholders account. Here we are going to use the short forms. In the exam also we are supposed to write ESH account and PSH account while preparing the ledger accounts. Likewise, CIA, there is a CIA in preference shareholder also. Just likewise, there is a CIA for equity shareholders also. So it will be ESH account debit side. Now the next part is reserves and surplus. Now, as we all know that equity shareholders are the residual owners, all the profits and losses are supposed to be bear by equity shareholder. So whatever reserves and surplus is given in the question, yeah, in the problem, will be transferred to ESH account credit, because profits are credit and it is on liability side. So liability side always all the items will be pushed on the credit side. Now coming towards secured loan. Secured loan is nothing but my external liability. So for external liability, we are having something called as realization account. And since it is a credit side, yeah, liability side item, it will be realization credit, and it will be posted on realization credit. Likewise, unsecured loan is also again and outside liability, external liability. It will be, the amount will be posted in realization account credit side. Next is current liabilities. It is also an external liability. It includes my creditors, bills payable, outstanding expense, and provision for tax. So this will be also transferred to realization account, and it will be transferred to credit side of realization account. So this is what all the markings we are supposed to do on the liability side. Coming towards fixed asset, fixed assets will always be shown at cost on in our realization account, and if the corresponding depreciation is there, we are supposed to show the opposite effect of it. Fixed assets includes your goodwill, patents, trademarks, know-how, land and building, plant and machinery. So all this item will be realization account debit, because asset always have a debit balance. So all the balances which falls on the asset side will be transferred to debit side. Depreciation, a specific disclosure is there, so we will be transfer it into realization account credit. Furniture, again realization debit. Depreciation, again realization credit. Delivery van, the cost part will be realization debit, depreciation will be realization credit. Investment is again an asset, so realization debit. All the current assets, that is stock, bills receivable, prepaid expense, debtors, they are also the part of an asset side, so it will be realization debit. RDD, that is reserve for doubtful debts, the marking will be realization credit. Now with respect to cash bank, there may be two situations for you. If cash bank is taken by the new company, it will be realization debit, and if it is not taken by the new company, then it will be cash bank account debit. So this we have to go through the adjustments. If in the adjustment, if it has been mentioned that all the assets and liabilities are taken over, then it will be realization debit, and if it is specifically mentioned that the cash bank account is not to be taken, then it will be cash bank account debit. Next part is miscellaneous expenditure. My dear students, if reserves and surplus is the part of equity shareholders fund, miscellaneous expenditure has to be the part of equity shareholders fund, because any profits, any losses has to be bear by equity shareholder. That is a basic funda behind it. So miscellaneous expenditure, whatever items are there, share discount, debenture discount, preliminary expense, profit and loss account, loss, the profit and loss account, asset side balance is always loss, this will be transferred to ESH account on debit side. So once this markings are completed in the books of old company, in the books of small company, we will be starting up with the steps. Now to reach the goal, there are 7 steps which a learner should follow while preparing the old books. First, I'll start it with calculation of PC. Once my PC is completed, my 20% of the chapter is over. That means if something goes wrong in calculation of PC, it will definitely have the impact on overall sum of yours. So first part is, once we read the problem, we read the question, the first part will be the calculation of PC. Second will be transfer. What to transfer? The balance sheet items to their respective place, as we have done here. You can see preference share capital will be transferred to PSH account credit, assets will be transferred to realization account, and so on. Whatever markings are given, we will be transferring it to various different ledger accounts. Next, after transfer, we will be passing on the PC entry. Now how the PC entry is to be passed, we will be seeing in the next slide. Next, after PC entry, if any asset, yeah, liabilities, if any assets and liabilities not taken over by the new company, it has to be settled. by the old company. Next, it will be realization expenses. Now this dissolution, this closure may have some realization expenses which is to be paid by the old company. So this step is called as realization expense. And last is closing of accounts, where means whatever ledger accounts we have open in the books of old company, we have prepared, that has to be closed. And last, ESH account should tally. If it is tallied, then your sum is correct, and if not, then we have to start from scratch. Now, what are the various ledger accounts which we need to prepare in the books of old company and small company? Because there's a big question that what are the ledgers and how many ledgers we are supposed to prepare. So the first basic ledger which we are going to prepare is realization account. Second, we are going to prepare ESH account. Third, we'll be preparing PSH account. Fourth, we'll be preparing new company account, yeah, big company account. Now, why I'm using the word new company and big company? New company in case of external reconstruction and amalgamation, and big company in case of absorption. Fifth, we are going to, if the PC is discharged in equity shares, so equity shares in new company account. If PC is discharged in the form of preference shares, the preference shares in new company account. If PC is discharged in form of cash bank, then we are supposed to prepare cash bank account. So these are the compulsory ledger accounts which we are supposed to prepare in the books of old company and new company. Now, after finding out after what are the steps, what are the ledger accounts to be prepared in the books of old company and small company, we'll be taking up the journal entries in the books of old company. First, we will be doing all the journal entries in the books of old company, and then we'll be doing the journal entries in the books of new company. Starting with the first part, in the steps, the first part was to calculate the PC. So there's a basic calculations which will be given. The second step was transfer. So my journal entries will start from transfer. Now whatever markings which we have done in the balance sheet, we are going to transfer it to various accounts through a journal entry. So here it is PSH account credit. So debit will be my capital. So the journal entry will be preference share capital account debit to PSH account. This will be the first journal entry if preference share capital is given in the sum. The second marking which we have done is PSH account debit. So the opposite name is calls in arrears. So we will be passing on the journal entry as PSH account debit to CIA account with respect to preference shareholder. Same way with for shareholders, that is equity shareholders. So the journal entry will be equity share capital account debit to equity shareholders account. We'll be transferring the CIA also. So ESH account debit to CIA account. So these are the four basic journal entries with respect to share capital transfer. Next is reserves and surplus. So whatever reserves are given in the sum, that is capital reserve, securities premium, revenue reserve, statutory reserve, foreign project reserve, investment allowance reserve, export profit reserve, and P&L account, it will be transferred to ESH account. So here the journal entry will be all reserves which are given in the sum account debit to ESH account. Next, we are having secured loan, unsecured loan, and current liability. So there are various examples of secured loan given: bank loan, debentures, mortgage loan, other secured loan, FD from public deposit, director's loan, sundry creditors, bills payable, outstanding expense, and provision for tax. So this all items will be transferred to realization account credit. So here we will be having a consolidated entry, so secured loan account debit, but in exam we are supposed to write individual items, whatever items are given in the problem. Unsecured loan account debit, current liabilities account debit, current liabilities account debit to realization account. So that is D entry. E. Now after completing the liability side, we'll be coming towards the asset side. Under asset side we are having different assets: fixed assets, goodwill, patents, trademark, know-how, land and building, plant and machinery. So that all assets we will be transferring. So realization account debit to fixed asset account to investment account to current asset account next. Depreciation and RDD, which has a specific disclosure, we will be transferring it to realization account credit. So depreciation account debit RDD account debit to realization account. Next, all the miscellaneous expenditure, that is all the losses, will be transferred to ESH account debit. So ESH account debit to miscellaneous expense account. So I've taken consolidated miscellaneous expense, but if in the some different types of miscellaneous expenditures are given, then we are supposed to consider accordingly. The next part after transfer is your PC entry. Now since the new company is going to take over the business, so the journal entry will be new company account debit to realization account, and here we are supposed to post the PC amount. Whatever calculation we have done with respect to step number 1 in PC, we are supposed to consider here. Now the PC can be discharged either in the form of equity share, can be either discharged in the form of preference share, can be either discharged in the form of cash bank. So that we need to transfer to the respective account. So equity shares in new company account debit. If we have received preference shares, so preference shares in new company account debit. If we have received purchase consideration in form of cash bank account debit to new company account. This will be mentioned in the problem that the purchase consideration is satisfied by way of equity shares, by way of preference shares, or by way of cash bank. After passing on the PC entry, the next journal entry will be asset liabilities not taken over has to be settled. It's a compulsory and silent adjustment. Now, all the assets and all liabilities are transferred to realization account. So this entry will be passed through realization account only. So it will be realization account debit to cash bank account, or it will be cash bank. If I sell a particular asset, cash comes into the business, real account rule says debit what comes in, so cash bank to realization account. So all the assets and liability which not be taken over has to be settled by the following entries. Next is some realization expenses, a dissolution expenses has been incurred by the old company, so we are supposed to pay. Now realization expense, as the word say, it's an expense. Expense follows nominal account rule. Nominal account rule says debit all expenses and losses, so we are supposed to debit this. So realization account debit, and it's an expenditure, it has to be paid, so realization to cash bank account. And the last step is closing of ledger accounts. Now while closing, first we'll always close cash bank account. If any balance is left out in cash bank account, it will be transferred to ESH account. So ESH is the receiver, so ESH account debit to cash bank account. Next, whatever purchase consideration the preference shareholders have received from the new company, it has to be distributed amongst all the preference shareholder of the old company. So the journal entry will be PSH account debit to preference share in new company account. Next, after distributing all the preference shares to the preference shareholder, there may be balance left out in PSH account. That balance we are supposed to transfer to realization account. So it will be PSH account debit to realization account, or opposite, if the balance is on opposite side, that is debit side, the realization account debit to PSH. After that, the last shareholders, the last party to receive the shares are equity shareholders. So whatever the shares are received by the new company, it has to be distributed to equity shareholders. So equity shareholders account debit to equity shares in new company account. And before closing ESH account, we are supposed to close realization account. The resulting effect of realization account will be profit or loss. So if it is profit, it will be realization to ESH account, and if it is a loss, it will be ESH account to realization account. So here we have learned the various different journal entries with respect to old companies books. Now, after passing on the journal entries in the books of old company, we will be starting up with the journal entries in the books of new company. Now, when we come to new company, the first entry will be called as takeover entries. It will be called as takeover entries. So since we are going to purchase the business of other party, a vendor company, so business purchase account debit. I have purchased the business, so business purchase account debit the PC amount to the liquidators of vendor company account, and the amount which we are supposed to post on debit and credit side is our purchase consideration amount, which we have taken into consideration while calculating step number 1. Now when I take over some company's business, the assets and liability of that particular company becomes an asset and liability of new company. So in our example which we have taken in the question, there are various different types of asset which are there: goodwill, patents, trade out, know-how, land and building, plant and machinery. So all that assets will be taken over by the new company. Even the investments, even the current assets will be taken. So goodwill will not come, because goodwill is the net resulting effect of the purchase consideration. So goodwill will always be a balancing figure which will not be taken over by the new company if given in the old books. So land and building at an agreed value. Let us say if we have plant and machinery, this all are the assets always have a debit balance, so plant and machinery account debit at agreed value. Then furniture account debit at an agreed value. Investments of the old company, a liquidating company, a vendor company, investment accounts debit. The debtors of the vendor company has also been taken over by the new company, so debtors account debit at an agreed value. Bills receivable account debit at agreed value, and say cash bank account at an agreed value. Then we will leave one line for the balancing figure, which will be either goodwill, either capital reserve. If the balance comes on debit side, it will be goodwill, and if the balance comes on credit side, it will be capital reserve. Now on takeover, if the assets comes into the business, the liabilities also comes into the books of account. So if there is any some debentures given in the sum, so to debentures account, because it's a liability at agreed value, so it has to be credited. Suppose creditors comes of the vendor company, so creditors account at an agreed value to business purchase account, the PC amount. Now we are going to tally this particular journal entry. As we follow double entry system of bookkeeping, every debit should be equal to credit and every credit should be equal to debit. The resulting effect of the journal entry may be either goodwill or either capital reserve. So if the balance is on debit side, it will be goodwill. If the balance is on credit side, it will be your capital reserve. So this is the second journal entry. C. Now I am going to discharge the PC to the old company or vendor company. So to liquidators of vendor company account debit PC amount to, now this PC can be in the form of equity shares, it can be in the form of preference shares, it may be in the form of cash. To equity share capital account, to preference share capital account. It can be in the form of cash bank also, to cash bank account. So this is the first part. So these three entries are mandatory on takeover. First is business purchase to liquidators. Second is all the assets and liabilities we are supposed to take over. The resulting effect will be the goodwill or capital reserve, and the third will be the PC discharge. Now there will be some other intercompany transactions by the both the companies, so that has to be set off. So other transactions, under that we have debtors and creditors. So suppose if A and B are going to merge. Previously they both were the competitors, one was a debtor and one was a supplier. Now but since these two companies are going to come together, the intercompany transactions have to be set off. So the journal entry will be sundry creditors account debit, because the liability is reduced. I'm not supposed to pay that liability in future. Likewise, my debtors is also reduced, that is, money is not going to be received from that creditors in past, of the past creditors. Next, likewise for bills payable also we may have the set of transactions. One has bills receivable, another has bills payable of the opposite company, so that has to be also set off. Then the last and very important and silent journal entry is the statutory reserve, which we need to bring forward. Yeah, we need to patch, which we need to carry forward in the books. So it has to be passed through amalgamation, adjustment account. So amalgamation adjustment account debit to statutory reserve account. We have done statutory reserve in our theory, wherein it speaks about foreign project reserve, it speaks about export profit reserve, it speaks about investment allowance reserve. So these reserves are called as statutory reserve, and they need to be carried forward in the books of new company. So that is nothing but a silent adjustment, and that is to be transferred to amalgamation adjustment account. So with this, I thank all of you, and will be coming soon with the practical aspects of this particular chapter. Thank you. Have a good day and keep learning.